Hello there, everyone. Welcome back. Today we are going to go over Chapter 16 in the Fisher textbook looking at income tax. And so this is another virtual lecture for Econ 132, State and Local Government Finance. And we've been talking about taxes this whole time, the last couple of weeks, looking at different ways that state and local governments earn revenue. And so today we'll talk about income tax. The slides should be posted on Canvas. Let me know if you have any questions, and let's get started. All right, let's get started. So this week we're looking at income tax. Next week we'll start talking about applications like education and transportation as we move into the second midterm and the position papers where you're going to actually have a debate, take a position on some of these issues we've been talking about and some of the issues facing California as a state. So in talking about taxes last week, we talked about sales tax. We had a really good time talking about sales tax, excise taxes, and how a lot of state and local government agencies rely on consumption taxes as a big part of their revenue. And the big debate in consumption tax structure comes from this idea of efficiency versus equity. Are we having a efficient tax that minimizes deadweight loss, or a tax that's more equitable and fair and is maybe more progressive and less regressive, and the trade-offs between those two? And so we looked at a couple of different cases. We looked at sales taxes on services. We looked at Amazon and e-commerce. We talked a little bit about trying to avoid taxes by buying goods in different places and the incentives, the perverse incentives that differential tax rates can create. We talked about how sales tax varies a lot from state to state. Some states have 0% sales tax. The highest is sales tax rate at the state level is California, although we're not that far off from other states like Indiana and Tennessee. But if you look at this graph here that shows a more granular level of data, California does have a very high state level income tax rate, but you can see a lot of other states also have additional taxes on top of the state level tax, and that's going to mean that some states like Arizona that have a low state level tax rate have higher taxes at the county or regional level, and that can generate a lot of additional tax revenue. We said that sales tax is designed to be a consumption tax, a full-on consumption tax, but it's not a true consumption tax because there are exemptions, right? We exempt prescription drugs, non-prescription drugs, food, electricity, and utility from sales tax in some states. California exempts prescription drugs, food, and utilities, and then there are local sales taxes between 0 and 2.5%, and that's the kind of stuff we've looked at where we looked at, say, Santa Monica having a higher tax rate than Sacramento, and both of those being higher still than the base state rate of 7.5. We've also talked about additional taxes charged on goods like gasoline and cigarettes because of negative externality effects. Taxes on goods like hotels and restaurant meals, which are designed to make the tax base more progressive and try to tax leisure activities. And that the revenue from these taxes are going to be really dependent on consumer choices and consumer behavior. We talked about the exemptions associated with consumption tax, the fact that we see a lot of goods taxed, not necessarily a lot of services. The housing exemption, right? Most housing isn't taxed, at least not directly. Professional services are usually not taxed either. And so what we get is this patchwork system where some consumption is taxed and some isn't, and a lot of things are taxed at different rates. And one of the inefficiencies we did mention that generates is an information cost, right? You don't know what something might be taxed, what the price of something is if the tax isn't transparent, isn't known when you go through. So, and then also when some goods are taxed and some services are taxed and others aren't, there's a potential efficiency cost associated with people changing their behavior to avoid the tax. And that gets back to price elasticity of demand. When we talk about use taxes, we wanted to remember the origin principle and the destination principle. Origin principle says taxation should be based on the origin of the sale, the location of the sale. Destination principle says taxation should be based on the location, the destination where that good or service is going to be consumed. So if I wanted to fly to Alaska and buy a bunch of salmon, Alaska has a 0 sales tax, so I wouldn't have to pay any sales tax on it, according to the origin principle. According to the destination principle, I should pay sales tax because I'm going to eat that salmon in California. The Amazon case study was an example of Amazon not charging sales tax for goods sold on Amazon.com, because even though the retailers or the affiliates might be California-based and the consumption is California-based, there are a lot of retailers, a lot of affiliates who weren't in California, and Amazon itself considered itself outside of that realm. And so it was a bit of a contentious back and forth between the state of California's government and Amazon itself. Amazon threatened to terminate its affiliates, and so eventually they came to a compromise where Amazon would eventually charge sales tax, and California would get a little bit of a compensation for its patients. And so now we see that online retailers like Amazon and Overstock.com do have to pay sales tax, or at least charge their consumers sales tax. And when we think about sales tax and efficiency, we want to remember that a tax effectively raises the price of a good or a behavior. And that's going to have 2 effects. The sales tax, making things more expensive, is going to have 2 overall effects. The income effect, which says, hey, higher prices make me feel poorer because my income buys less stuff, less of everything. And so that income effect is going to reduce consumption of all goods when the price of anything goes up. The substitution effect, or the price effect, says that also when something becomes more expensive relative to everything else, I'm going to select away from that expensive good. So if we tax beef differently from chicken, if beef is taxed at a higher rate, I'm going to choose to select away from beef and consume more chicken in order to avoid that additional tax. And that creates a whole nother set of economic inefficiencies, consumers changing their behavior to avoid taxes. And we've talked about this a lot, so it should be a good review. The compensated demand analysis that comes from Ramsey is the graph we spent a lot of time on last week. We went over this together twice. And basically the big idea here is that the optimal set of sales taxes for leisure and necessity goods should cause an equal proportionate decrease in the quantity demanded of those commodities. And so that there's multiple answers to the question of how to tax leisure and what the efficient set of taxes is. In this case, tax C at P naught, if you look here, that is a single tax for both goods, but it is not welfare enhancing. The welfare enhancing tax would be the separate tax, tax A and tax B on good A and good B. So tax C creates a greater inefficiency than the 2 differential taxes because the consumer surplus loss is less with A and B than it is with C. And I'll try to post a picture to show you guys that. I'll post an answer key for y'all for that one because that's a weird one. That's one of the more difficult models we've looked at so far. So that tells us that taxing is complicated. The tax structure, the optimal tax structure, might depend on more than one thing. It's going to depend on price elasticities of demand. It's going to depend on price elasticities of supply. It's going to depend on how consumers change their behavior. And it's going to depend on what kind of revenue we're looking for. So the differential tax rates might be more efficient than a single tax rate. In some cases, the optimal tax rate is 0. And it's really difficult to determine the optimal tax rate. We don't necessarily know that. Economists want to minimize those inefficiencies, but they also want to try and make a tax structure and a tax base that is not harmful to low-income households. Taxing leisure is going to be difficult to do, and so we try to sometimes tax complements to leisure. And one of the ways that economists have thought about reducing the inefficiencies is to reduce the tax and tax more levels of productivity. And that's what a value-added tax, a VAT tax, would do. but we haven't done that in the US yet. Some countries in Europe use a value-added tax. Border effects. We ran out of time to talk about this. So what border effects are is another example of an inefficiency that could be generated from differential tax rates. In this case, we have two jurisdictions, and we can think of the high tax jurisdiction being, say, California, and the low tax jurisdiction being Oregon. That border effect is just saying that if both jurisdictions, both states, tax the same good X, the higher tax rate in California is going to lead to a decrease in long-run supply of the good because of those high prices, because of reduced demand. It's going to move us up that demand curve. And because consumers are going to select away from the high tax jurisdiction into that lower tax jurisdiction, into, say, Oregon, and demand more goods in Oregon. And so that's going to give us a inefficiency, a deadweight loss, an excess burden in both markets. So basically, there's two lessons from this example. One is that differential tax rates create an economic inefficiency, right? Create a deadweight loss because of people avoiding that behavior. And this is something new we haven't talked about. The differential tax rates, the higher tax jurisdiction, affects the lower tax jurisdiction. So our tax rates here in, say, Sacramento County might affect the deadweight loss and the demand and the market in a bordering region. So tax rates, sales tax in California affects markets in Oregon because of that border effect. Does that kind of make sense? So like there's increased demand for cars in Oregon because of Californians driving across the border to avoid sales tax. Something like that. Hopefully that makes sense. If not, hit up the discussion thread and let me know. So a truly general consumption tax would impose a burden on consumers proportionate to their consumption level. However, several studies show that this tax burden of sales is that sales tax burdens are borne fully by consumers, meaning the incidence is not going to suppliers. They know we'll pay the price increase, and so they charge it to us. The other thing we know is that high-income individuals are going to have consumption be a lower portion of their income overall. And so sales tax is perceived to be a pretty regressive tax in that the burden of sales tax and consumption taxes fall more to low-income households than to high-income households. And that's one of the big reasons why we exempt necessities from the sales tax structure. So that was sales tax. Hopefully it makes sense. We spent a good amount of time talking about it. It's a tax that we all interact with and that people, even non-citizens, even tourists, pay. And so that's an important source of revenue. So now let's talk about income tax. State and local governments rely on income tax for revenue. Income tax was equal to about 2.2% of the personal income generated in 2011. And that's a little over $250 billion in state revenue. In California, state income tax is a big part of our total revenue, 70% of total revenue. We have a lot of high-income individuals. Estimated income tax for 2017-2018 was $90.9 billion. That's a lot of money. That's a lot of revenue. So how does it work? The general form for income tax is that you have your income minus exclusions. Exclusions are income that is excluded from taxation. So if you contribute to a 401k retirement fund, that's income that is drawn away before the income is taxed. It's excluded from taxation. Exemptions and deductions are different in that they reduce your tax liability. So rather than taking some of your income and putting it away to be not taxed now and save it in an account, like a 401k, exemptions are things you spent money on that the government wants to reward you for. So you can get deductions for charitable donations, exemptions for the size of your family, and then you multiply that income that remains after you take out exclusions, exemptions, and deductions by the tax rate. And that gives you your taxable income, your tax rate, and then you get another subtraction for any credits. So you get a credit for having a child and a couple of other things. And so basically, your adjusted gross income is your income minus any excluded income, and then your taxes are based on that adjusted gross income minus exemptions minus deductions times the tax rate minus credits. Personal exemptions are a per person amount that's subtracted, basically saying, okay, take into consideration the size of the family. Deductions are those personal expenditures that can be subtracted from your income tax, things like charitable donations, education expenses, mortgage interest, what else? We try to subsidize behavior that way. And then the tax rate is the percentage of tax that is owed of the tax base that will be owed as a tax. A flat tax would be one tax rate for all of the income. So you have to pay 8% in income taxes. We don't have that system here. Some people argue for it. It would be simpler, but it would probably be a little more regressive. What we have is what's called a progressive tax. And that means that different levels of income are taxed at different amounts. And so what would that look like? Kind of is confusing. So we'll do an example. So here we have an income of $50,000, and that's a person's annual income. And then we want to exclude some of it. And so what we're going to do is we're going to exclude $100 worth of bond interest. And state and local government bonds, you do earn income on them in the form of interest payments from the state or the local government entity. But it's exempted, and so you can exclude that income from taxation. It is not taxed. So you have adjusted gross income is your income minus your exclusions. So already this individual's adjusted gross income is $49,900. Then we remove $3,000 per person in the household. So a personalized exemption for each of those people is going to be $3,000 plus $3,000 plus $3,000. So subtract $9,000. And then the deductions are going to be those things we talked about where we subsidize people's behavior. So a mortgage or property tax deduction, education expenditure deductions. You can get a deduction for charitable donation, deduction for moving from work for work, deductions for medical expenses, and all of those reduce your tax liability more. Then we apply the tax rate. In this case, we're just going to apply a flat tax of 10%. And then you get a credit for childcare expenses. And so that would give you the total tax payment associated with this individual. And I'll show you how to do that in just a sec in another video. What we want to look at here, this is the progressive tax rates and tax brackets for the state of California. And so remember, there's state income tax and federal income tax. California collects its own income tax, and then some of that can be deducted federally. The first, if you are a single person, so the tax rates are different whether you're married, filing jointly, or single. And basically the idea is married people have one person earning twice as much income, or one person earning income, and so they should be taxed differently. It's a little bit of an antiquated system. The IRS hasn't really kept up with modern times. So let's look at the single tax bracket. So if you're a single individual in California, up to $8,014.99, it's taxed at 1%. So you only have to pay taxes of 1% on the first $8,014.99 that you earn. Once you hit $8,015, it becomes taxed at a 2% rate. So all the income between $8,015 and $19,000 is taxed at 2%. The next group of money, the next tax bracket between $19,000 and $29,988 is taxed at 4%. And so that's what we mean when we talk about a progressive tax structure. Each section, each bracket of income is taxed at a different rate. The higher you go, the higher the tax rate. The lower you go, the lower the tax rate. And so it's not like income is taxed at one rate. It depends on how much income you have. And everybody, even a millionaire, their lower income is taxed at that lower rate. It's only the highest sections, brackets of their income that are taxed at a higher rate. Hopefully that makes sense. Let me know if it doesn't. Okay, so now that we hopefully understand California's tax brackets and tax rates and how a progressive tax structure works, let's talk a little bit about those deductions. So like I said, the deductions are designed to subsidize or incentivize certain behavior that our government has decided is favorable. So charity, good. Children, good. Keep having children, create more labor, that's good. Student loan interest, tuition, and educational fees, good, right? Human capital is a public good, a positive externality good, so we want to subsidize that. Business travel, depreciation, business expenses, a lot of that comes in when you're owning your own business, but also good, right? Good for society, good for the economy. Healthcare expenditures, another public good, right? Another positive externality. If you take care of your health, it puts less burden on the system. And then there's also energy efficiency credits and then mortgage interest. That's one of the ways that our state and local governments and our federal government subsidize home ownership. It's one of the great big home ownership subsidies that we see in the United States. So that's another massive deduction. Looks like I lost subtitles. Okay, so what do we know about income tax from the economic perspective? From an economic perspective, we can think about what some of the other economists have looked at. Young and Berner looked at the result of additional income tax increases on high-income individuals in New Jersey and California. And basically what they were looking for is, do millionaires and other super wealthy people move to avoid high income tax rates? And this is kind of important for California because we talk about this a lot. We're actually talking about, billionaire taxes and all these things. And so the question is, will we scare away these high income individuals with this income tax? Will they avoid the tax by moving, or will we actually end up generating additional tax revenue? So from 2005 to 2015, California lost about 800,000 low-income households, but they gained about 20,000 households earning at least $100,000 or more per year. And so what that seems to imply is that we are losing low-income households, but we're gaining high-income households. And so it's sort of just a increase in the average income level of the average Californian. Werner looked at the results with a working paper, and based on ballot measures in 2012, he saw that the income tax rate was higher, and of the highest income individuals, about 138 people moved out as a result, according to Werner. And so what he's saying is there is some movement. There are some people who move out to avoid those high income taxes, and what the effect on the tax base is remains to be seen. SALT deductions, or state and local tax deductions, basically exempting some income or deducting some income tax liability based on the taxes you paid locally, can make this effect a little bit bigger. And here at the end, we have a little video that goes over this. I'm not going to play it for you. This is going back to a couple of years ago. The Trump administration put a cap on SALT, or state and local tax deductions. And basically what that meant was there was a limit to how much you could deduct from your state and local tax, your state income tax, on your federal income tax. The cap didn't affect states where there's a low mortgage deduction, but states like California, New York, New Jersey, where real estate is really expensive, and so mortgage tax deductions are a higher number, a higher value deduction, it really harmed those individuals and raised their effective tax rate. And so that's worth taking a look at. Oops. Okay, so that is income tax. Short and sweet, right? I'll put together a little participation activity that we can do to practice income tax, try and give you a sense of how it works, how the tax bracket and the progressive structure of our tax rate works, and get a little experience with that and get a sense of it. But the big ideas are that income tax is a tax on income, so economists always worry about that effect on productivity if it creates a disincentive to work. The idea that we try to make income tax progressive, which is why we see those tax brackets, and each section, each bracket of income gets a little bit higher tax rate, a little bit higher tax rate, that we use deductions, exemptions, and excluded income to incentivize certain behavior. And the other thing that you'll see when you actually calculate a tax rate is that somebody's actual effective tax rate, the rate at which their income is truly taxed, is usually less than the listed tax rate associated with the tax bracket because of those exemptions, because of those ways that we try to subsidize behavior and alleviate poverty. And so those are the really big ideas there. And then the question is always, what are the other perverse incentives or unintended consequences of income tax? So, for example, high-income individuals leaving the region. If we increase the tax too high, we might scare away a lot of high-income individuals, and that could harm our tax base and maybe our economy. So that's income tax. Oh my gosh, we're done with revenue. That's so exciting. So that's everything we have to say about income tax. We'll come in next time and look at the applications of education and transportation. We'll talk more about midterm 2 and the review and exam for that. And then we will look at our position papers. And that's going to be the final project for the semester, which is writing up a paper, taking a position on what are the big pressing issues in California finance, in state finance today, whether it's property tax base, whether it's how we're going to fund water and education, one of those issues. And so you want to start thinking about what you're interested in or what you might want to write about and what you believe about those issues. Do you believe we're doing something wrong or doing something right, or that there's a solution to education or roads in California? So that's it for the lecture for Monday, April 18th. Let me know what questions you have, and I'll see you all next time. Thanks so much.